Most people believe wealth is built by picking the right ETF. That is not what makes portfolios grow. Portfolios grow because investors stay consistent long enough for compounding to take over. And consistency does not start with investing. It starts with stability. Before thinking about monthly contributions, there is something more important. You need an emergency fund. At least a few months of living expenses in cash. Because investing without a safety buffer creates a hidden risk. If something unexpected happens and you suddenly need money, you may be forced to sell your ETF portfolio during a market decline. That locks in losses, that interrupts compounding, and that turns a temporary downturn into a permanent setback. An emergency fund protects your long-term plan from short-term life events. It allows you to stay invested when markets fall. And staying invested is where real wealth is built. There is another uncomfortable but important truth. If you earn less than €2,000 per month after taxes, your first investment might not be ETFs. Your first investment may be yourself. Increasing your income permanently increases your investing capacity. Improving skills, negotiating salary, switching jobs, building additional income streams. A higher income increases flexibility. Flexibility reduces stress. Reduced stress increases consistency. And consistency compounds. There is absolutely nothing wrong with investing €100 or €200 per month when you are starting. In fact, starting small is powerful. You learn how markets behave. You experience volatility. You understand how it feels when your portfolio is down. You build emotional tolerance. I personally started this way. Small contributions, steady investing, learning through experience. When the amounts are small, fear is manageable. And habit formation becomes easier. The habit matters more than the number. Once you have a stable income, an emergency fund, and financial breathing room, now we can talk about building serious wealth. The question shifts from how much can you invest today, to how much you need to invest to become financially independent in 20 to 30 years. This is where long-term compounding becomes extremely powerful. If you search for the Capital Group Investment Calculator, you can model this yourself. Enter your starting amount, your monthly contribution, and an estimated annual return. Historically, global equity markets have returned around 8% annually over long periods. This is not guaranteed, but it is a reasonable long-term planning assumption. If you want to reach €1 million in roughly 21 to 22 years at an 8% return, you would need to invest approximately €1,500 per month. That sounds large, but the real lesson is not the monthly amount. It is the shape of the growth curve. For the first years, growth feels slow. Your portfolio increases steadily. Nothing dramatic happens. The graph looks almost flat. Then around year 10, when the portfolio approaches roughly €200,000, something changes. The earnings generated by the portfolio each year begin to accelerate. Eventually, your annual portfolio growth becomes larger than the amount you are contributing each year. From that point forward, compounding takes over. The curve bends upward more sharply. The portfolio begins to feel powerful. Money starts working harder than you do. But this only happens if you stay consistent long enough to reach that tipping point. Compounding rewards patience. It punishes interruption. This is where most investors fail. Not because they invested too little, but because they stopped. They reduce contributions during downturns. They hesitate when markets fall. They lose confidence when growth feels slow. And they interrupt the process before compounding has time to accelerate. The journey to financial independence is not dramatic. It is repetitive. It is structured. It is disciplined. You invest every month. You ignore short-term noise. You stay diversified. You keep costs low. You rebalance occasionally. And you continue. That is what builds wealth. Not excitement. Not predictions. Not timing the market. Consistency. So how much should you invest each month? Not the maximum you can possibly afford. Not the amount that looks impressive. But the amount you can. Invest automatically. Maintain during downturns. Increase gradually as your income grows. And sustain for decades. That amount may start small. It may grow over time. But what matters is that it continues. If you combine a simple diversified ETF portfolio, an emergency fund, rising income over time, and consistent monthly investing, you build a system that compounds. And over decades, discipline has historically been rewarded. Short-term fear has not. Before closing, a brief disclaimer. This video is for educational purposes only and does not constitute financial advice. Investment returns are not guaranteed. Markets involve risk, And you should always consider your personal financial situation, risk tolerance, and goals before making investment decisions. Do your own research or consult a qualified financial professional if necessary. In future videos, I will continue breaking down practical ETF investing topics step by step for European investors. If this structured, long-term approach is useful to you, consider subscribing. And if you know someone who is unsure how much to invest each month, sharing this video might help them build a plan they can actually stick with.